Nowadays, got it. Okay. Nowadays, the margins are very, very slim. In many cases, much thinner. Particularly, we see this when we go to the auctions and stuff. So, uh, I wanted to be able to have whenever I'm doing evaluations, all the numbers with all the costs, whether I'm looking at doing a flip, a rental, or the third option, we're looking at even with owner finance. So that then I know entirely, not just looking at the purchase price and the ARV, but everything as much as possible. And I was finding a lot of the tools out there that I had didn't have everything, didn't have all of the interest rates and the holding costs. And when you come into rentals, the maintenance fees, and we'll get into those and you'll see what I'm talking about. But that was kind of the why I was starting to create something to expand on other tools that I had seen. Plus, depending on where you are with your planning on building your portfolio or where you're at with on your own kind of growth to get to that financial freedom, may depend on what your exit strategy is. Joe has said to us in many of these meetings before that you need to have a diverse portfolio, be it, needing immediate cash or that long-term cash if you're looking at something more passive income over time instead of a lump sum today, make more money with that passive income. So I wanted to be able to, whenever I saw a deal, be able to look at all the numbers and then look at all the exit strategies to see what's that best option, whether I'm looking to flip, looking to buy and hold, looking to do BRRR. For those of you who don't know what BRRR is, that's when you buy it, you renovate it, you rehab it, then you refinance it to get your cash back out, and then you rent it. So after you have that new long-term note, that's your BRRRR method. So I want to be able to see all those, to include owner finance. And we were talking about that a little bit with one of the other ladies online before we started here. And so that's why I kind of originally started putting this together. And it has grown over time as things have come up. So there's a lot of experience has kind of gone into this. I actually, in a couple of mine, regretted the decisions that I made. I had 2 other flips that I was doing, and I was only focused on flip. And on the one, the market shifted. And so I made very little. I didn't make the full margin that I was expecting on profit. I only made a smaller amount. On the other one, I ended up with a contractor who was, we could have probably taken him to court, but basically he was doing illegal things. He was putting old HVAC systems in, even though it was all supposed to have been new and everything else. So we ended up again on that one just breaking even when we should have made a good profit. But if I had known the numbers and what I could have made on a rental, I wouldn't have sold it. I would have hung on to it instead, because I didn't make much on the profit. If I would have just refinanced it, hung on to it, and then rented it, I would have been sitting pretty right now, because that would have been 3 years ago and it was on the coast. And we all know what's happened with the prices. They've gone up. So those specifically were 2 examples where I wish I had had more information. I wish I had known more about the other exit strategies than what I did. And that's kind of how I grew a lot of that. And I've actually leveraged this very tool with a flip that I just finished in Grand Prairie that I ended up with a whole bunch of termite damage. So my rehab costs went up. So now I'm looking at, okay, flipping, I can make decent, but not best profit. I'm now looking at, do I hang on to it, let it continue to appreciate doing rentals or doing owner finance? So that's why I wanted to have the numbers and have the ability to get there. Let me go ahead and share my screen and show you the tools that we're talking about that can give you all of that information. Okay. All right. So can everybody see my screen all right? All right. Good. Thanks, Joe. Okay. So what we have, we call it the Flip, Buy and Hold BRRRR Analyzer. So basically, this is intended on focusing on evaluating a property if you're looking to flip, keep it as a rental, or and also keep it as a rental and do the BRRRR if you're going to end up refinancing it. So we've added a lot. This has kind of happened over time. I saw a couple of people who were who logged in who actually purchased our real estate exit strategy analyzer version 1. This you're going to see actually going to roll into the owner finance module at the end. We've really expanded what we started with originally that we had last November when I first presented a version of this. So I want to kind of show you, give you an overview. We've tried to make this much more intuitive than the last version. Basically, anything that's in yellow are blocks that you would fill in. So at the top section, it would have all the purchase and sale data. Here in the middle is where you would enter all of your rehab information and the financing during the rehab. And then at the bottom, oops, come on, cursor, is where the rental information would go in. And then once you fill in all of these yellow blocks, what that provides you over on the right, this gives you your summary of your flip to include what your kind of deal to no deal indicators. And we've tried to make this flexible enough that you're able to put in what your particular goals are. Down below the flip is where you now have the analysis information for a rental and also the different performance indicators that come with that. I'm hitting this very quickly because I got about 7 examples that I'm going to run through just so that you can see all of the capabilities that this tool can provide and the information that it delivers to you. At the bottom is where it gives you the future projections for the rental. And we'll go into this in more detail. But over on the right, you see where these plus signs are? You're able to expand that. Come on, computer. And it drops down for each year. So it actually, this is by year is what I have it rolled up as, because I've collapsed them. But it actually goes out for the full 360 years or months. Try again. Payments that would go into a full 30-year note. You can see as I scroll down. So you can basically end up expanding that. So this is the Analyzer tab, the first tab here. If you look at the bottom here, you can see I have the next tab is the loan comparison. So when you're doing real estate, for those of you who are experienced in it, you know that there's a lot of different ways that you can finance your deals, either by using private lenders or hard money lenders, using your own cash, or if you're going to be pulling out perhaps out of like if you got a solo 401k, or if you have an IRA that you can control, a self-directed IRA, you may be using cash. Or if it doesn't need a whole bunch of repairs, you might be able to use a traditional lender. So these are the next two. If you have a lot under your belt, like Joe does, he doesn't get the luxury of using investor loans anymore. So he has to go commercial. Many of those are interest only, and then they'll roll into your traditional principal and interest payments after the construction period. So there'll be an interest only period. So that's like a hybrid here. So this is what I have in this option. Or if you're already a landlord and you have existing loans, this is the last example here at the end. For those of you who are familiar, sometimes maybe if you don't have all the money to put for a down payment and you're looking to leverage what we call a gap fund, a gap lender, that's a person who will then provide you a second note to help cover, say, either the down payment or perhaps the repair costs. So that will be your gap lender here on the end. And what this tab shows you, it gives you the ability to then, hey, Joe, can you make sure everything's muted? Because I'm getting feedback on my end. Thanks. But what it gives you the ability to do is that you can now compare your lenders, because it may be the fact that, you know, some of them will have more points and maybe a lower interest rate, or maybe a higher interest rate, but no origination at all. Well, you need to see, depending on if you're doing a quick rehab, then you might be okay with a higher interest rate and not have to pay the points, because you're not going to be having the loan out for very long. But if you got a major rehab that's going over time, it may make more sense to go ahead and pay the points and then take the different interest rates. So this allows you, as you're calling around and talking to your HMLs, the ability to put in the terms of those different loans, and you can give that comparison. And then down here, it tells you what that loan cost is going to be during the renovation period. When you farther down on this tab, it then continues to roll down and takes the purchase price, tells you what your down payment would be, and then how much money you need to bring to closing. All right, I just unmuted myself. Sorry. Sorry. This now gives you the ability to evaluate the different loans and then tell you how much it's going to cost for that lender. The next tab helps you figure out that ARV. So always, if you're looking to flip, you need to know what that after repair value is going to be. So that's what this tab does. It gives you a spreadsheet where you can put in your comps that you would normally get from your realtor, put the information in here. And here's the key on this, is that down here, we've taken a lot of experience and a lot of conversation with appraisers and put that information here to give you some ideas and rules of thumb. Now, obviously, it depends on the appraiser. It depends on your market. It depends on the time. But this is kind of what we have typically found. If you end up with, a house on your comp that has one less room, then you can probably reduce their price by $10,000 compared to yours. Versus if they have an additional room, then you probably need to adjust the price, because that's what you do is you'd put your comps in here. It determines what the cost per square footage is. Then you put in here the adjusted price. So if perhaps maybe they haven't renovated and they still have that pink toilet from 1950s, where you've got a brand new, newly renovated house, then chances are, then put those notes in here. This is how you need to go in and evaluate your comps to determine how you should adjust the price. And then it rolls up into the top here. You then decide what you want to for the ARV, your cost per square foot, based upon now your analysis. So it handholds you and helps you determine what your ARV would be. On the next tab, similarly, this does the exact same thing for rentals. It gives you a place where you can put in, you go like to Rent-A-Meter or Zillow Rents and download and see kind of what the rental price is going in your neighborhood. This also talks to you about, how far out you should go, where to try to keep, the guidelines when you're trying to do comparisons. Usually in these, no more, it's by bedroom when you come to rentals, but we're still keeping it as consistent, just looking at the cost per square foot. But that's where you would adjust your rent price here based upon your evaluation of those comparisons. So it gives you a place to kind of how to put your thoughts together, put everything together when you create what your financial plan is for this flip. So that kind of walks through the different tabs that we have on the in the analyzer. I'm now going to take an example and run it in. So through the numbers so that you can see how the numbers change and how it affects everything over here on the right with the analysis. So my first example, we're going to take the scenario, and these are real world examples. This is actually a flip that I have. I've changed the street name to, protect the innocent. But this is actually the details from a flip that I have. And now I'm going to run the numbers. If I'm going to use an HML, a hard money lender, who bases their loan off of the purchase price. So I'm putting the date in here for the closing date. Well, I guess it's not quite 2021. We'll say it's 2024. Get a little closer. On this particular one, the purchase price was $187,500. %1 is when we're running the stuff out of the way for the closing costs. And this right here tells you, so if I put in the percentage, 1% is usually the standard rule of thumb. But as you get experience and what, if you've got yourself a good title company and what they're charging, then you can adjust these. If you're in a situation where you're paying a wholesaler fee, so your closing costs are going to be more, then you might want to increase that percentage. The other thing, if you notice that pop-up that came up throughout this document, I have a lot of little comments and information, either to explain, say what a particular indicator is, or what a rule is, or what the general rule of thumb is. Now, again, we're not lawyers, we're not CPAs, and everybody's investment is their own risk, but we've put a lot of experience kind of nested inside these comments to help you out and give you some guidelines. So as you can see here, like on purchase price, it tells you what to put in here. If the property was previously owned, then you put in 0, and then you zero out the closing costs for the purchase. So you can see those things there. It's throughout that way. So coming back to this, I put in my purchase price. I put in the 1%. That gives me a closing cost of $1,875. I'm now going to go over to the loan comparison. And I told you I was going to take an HML who bases their loan off of the purchase price. So we're over here and looking, it's going to be an 80% loan to value. You can see at the top, this is already pulled in the purchase price from the front slide. This will also put in, and I didn't go ahead and add it yet, the ARV. Actually, let's go ahead and do that. Let me back up here. Sorry. So I'm going to go ahead and start with the top. Go over here. I'm going to estimate that we'll be closing this in October. The ARV is going to be $290. And I'm estimating closing costs at 7%. I'm not a realtor, so I know I'm going to have to pay commission on both sides, estimating 3% commission on both sides and 1% for the additional closing costs. So that puts me at 7%. If you end up in a situation where perhaps you're having to pay consideration, or if you're agreeing that, hey, you're not going to make a repair, you'll give them a reduced price, then you can go ahead and add that. That's what this here is for. It's kind of a catch-all, any other costs that haven't been identified somewhere else. Because I said, I wanted to make sure the fact you're able to capture all of the costs possible. So you'd have that information in here. So now we've got the purchase and the projected sales. Going back to the loan. So you see up here, it automatically pulled in the purchase price, the ARV, and the closing costs. It will pull in the rehab and the time period when we fill that in here in a minute. If you ever want to use this and just yourself go in and play around with the numbers and see, well, what if this and what if that? You can change these numbers because I didn't lock these down. But if you ever want to go back and pull it back, you just type this information back in the cell, then it'll automatically go back and pull it from your analyzer page. So that's a flexibility there. Also, if you ever want to just test things, the hybrid here, you could put anything in the loan amount, anything that's yellow, you can fill in. So you can see, you can here in this section manually put in your whatever you want for your loan, the terms, the points, etc. So that's another side that you can, if you just want to test and see what would my payments be, what if, and put that in there. So coming back over here to our scenario, 80%, that means the loan's going to be 150. I have 1 point, which is fairly common with a lot of HMLs. And then I've got a 9% on my interest points. So that's going to tell me my total lender interest is going to be $1,125 during the rehab period. My total cost that I'm going to pay for that loan is going to be $2,625 because that's taking the points and the total interest. Go back to the analyzer. So that's pulled that in here. You can see that here. So we had our lender points added. Now, when I go in here to the rehab, so we're moving down into the financing and the rehab. So I told you that these two are linked together, the loan comparison. So this is where you select which scenario for a lender you're using. So if you remember, I'm using number 3 here. So I'm going to come back to the analyzer and I'm going to pick number 3. And you saw these numbers change. So I've picked the number 3. I'm now going to come over here to the rehab side. My rehab amount is $45,000. I'm looking at taking about 4 months. That's going to be rehab and sale. So you want to have all your time that it's going to basically be held up. It's for holding because they're going to use this to determine holding. I'm looking at 200 on utilities. My taxes, I'd already did this calculation. It's $291.66. I divided by 12. And then my rehab insurance is $150. So that's all the information for the loan and the rehab. So that come down here. This is now telling me my loan cost during rehab, if you remember that was on the other page, was $1,125. My total holding costs is going to be $1,766 a month. That's my monthly cost. This is my monthly interest. This is my monthly cost. So if down the road you find that, oh, you had a hiccup, so you're delayed a month, you didn't get done in 4 months, 5 months, you know, or if your contractor's slowing you down, you know what that cost is. So you can have that discussion with him if you wrote your contract, hopefully, in terms of with delays, that you now have a cost that you can charge him for delaying. This is calculating it for you so you know what your holding costs are. Over here on the right, or sorry, on the left, this is the total loan amount that you're going to be making during the rehab. That's $4,500. The funds needed for just the rehab and the holding costs is $47,567. Now, obviously, first thing you got to find out is how much money do you actually need to close. You got all these numbers in here, and I'm not throwing a lot of numbers at you. How much you got to close? That's what this number is right here. So to go ahead and close the deal, you're going to need $40,875 to do the whole project. That just gets you the house. To do the house with the rehab and the holding, it's going to cost you $92,942. So that's how much you're going to need in order to execute this deal. Over here on total costs, this is tell you what your total holding is for that period, and that's your total rehab costs. So the way this one is set up, because I'm going to show you a gap in a minute, but I wanted to show you one that's using just a regular HML off a purchase price. That means that I'll be bringing 92. So maybe perhaps I'm going to be pulling out of my self-directed IRA or a solo 401k, because it's only for 4 months. So then over here, this is telling you how your numbers are working for your flip. So I got the purchase price minus my closing costs, minus rehab, utilities and insurance. This is the cost to close. So pre-financing, the project cost is $257,000. I add my lender costs. Then I turn around and add, that gets me my total project is $263. With a sale price of $290, that means my profit is $26,758. That's, even though that may seem like a lot for 92, but for 4 months, 92,000 can turn around and give you 26,000. That's 28% return on investment. I don't know not too many mutual funds will do that in 4 months. Give you a 28% return on investment. So what this table over here provides is it gives you that visual, because when you start getting into selling a house, they may come in and say, well, what if it's, what if somebody offers you $280? Well, how's that going to change your numbers? Well, that's what this is over here for. So this kind of gives you in increments of 5,000, both above and below what your original projected ARV is. So you can also see if you're starting to see houses selling not at $183 a square foot, maybe they're, because of interest rates are coming down, you're now seeing similar houses selling at $180 a square foot, then you know kind of what you're looking at for that ARV. So you can kind of see what those adjustments are. Down here with the flip deal, no deal indicators, this I left full control up to you. So you determine how much is your goal to make. So if your goal is to make 10% profit, then you can put that in here, and this will sit here and tell you if you made that goal or not. So let's say you wanted to make instead of 30%. You're greedy. You think we're going to solve world hunger with this deal. Well, you can see where these automatically change. So instead, going back to something a little more conservative, let's say 15%, whoops, 150, that'd be nice. Then it's going to sit there and flip this puppy back. All right. Oops, not quite. Let's go back to 10. See, it automatically changes color. If perhaps instead, because that's the thing, I mean, back in the day when our sweet spot, even just when Joe and I started 4 years ago, we were looking at 150 to sell a house at 200. Now it's hard to find houses like that. Most houses, well, after you fix them up, you're looking at, more like 275 to 325, a lot higher. So maybe instead of a percentage, you're saying, look, my time in 4 months, I want to make at least 10,000 to clear. So this is where you can put in a flat rate. So if it's a flat rate of how much you're wanting to make, you can put that in there. So you can set those to help you when you're evaluating what your prices are, to go ahead and give you those color codes. This 70% rule, this was always, when I first got trained on how to flip houses, they always said the fact that you needed to have, whenever you're looking at a house, you should be looking at a 70% 70% difference when you're looking ARV, minusing out basically what your purchase and repair costs are. Well, it's hard to make those numbers work, but I went ahead and left that one in there because that is still a general rule of thumb. But that's why I added these other two, so you can put your own discriminators in there. But then you still see what the old rule of thumb was. And that's where I pulled and kind of give the definitions in the comments here. So that's the flip portion of this analysis. So now let's scroll down a bit and look at what if we want to compare this to a rental. So when you scroll down this next section, first, you got to put in the date of when you're looking for that comparison to be. So when you're going to start that rental. So in this particular case, we said the holding was 4 months. So Jen, and if I'm closing in April, that would put me in August. So I've got August in here because I got 4 months as the holding period. I scroll down. This section here is where we'll put all of our rental information on the right, but on the left is where we're putting all of our long-term financing information. So just by holding my cursor over the long-term financing, you can see there's a detailed explanation of what it's looking at. So as I said, there's a lot of different ways to skin a cat when it comes to real estate and financing. So depending on your particular parameters, we've tried to accommodate a lot of different scenarios, but that's why you want to read through the comments and information. It tells you how to fill it in. In this particular case, is the same loan being used? No, it's not, because if I'm going to rent it, this was an HML. I'm not going to keep the HML long term. We're going to try to flip that puppy out to a better interest rate. So that answer is going to be no. I'm now going to put in what my projected loan amount is going to be. So my plan on a long-term rental is that I would be looking to do a cash out refinance, the BRRRR method we talked about. So I've done the flip. After the flip is done and the house is in its ARV condition, I'm now going to go ahead and get a refinance and get a new appraisal done. Typically, those are going to be off of an ARV value. So in this particular case, and this is where you can go back to this calculator and kind of see, right here's your cheat sheet. You can see a lot of times they're at 80%. So if I go in at 80%, oh boy, sorry, I got a cat coming in here. Hang on. Monty, thanks for the help. Always got to get sidekicks to help you out here. Okay, you got your ARV at 80%. I have, instead of points, I'm going to zero that out. I'm going to have a flat rate of 1,500. Now I'm just plugging it in here just to give me the numbers. Monty, you're really not helping me here, buddy. For 1,500. But the only reason is because I wanted to be able to get the amount that was in here. Fit, please. Should close my office door. So that gave me what my ARV is at 80% loan to value for that long-term loan. Coming back into here. Checking real quick. Ah, now I see where my challenge is. All right. So my numbers were actually at the 75%. Sorry, I misspoke because that's my loan amount wasn't coming up what I had in my cheat sheet here. So it's at 75% loan to value. I've got 117,500. The cat is winning, not helpful. All right. So coming back to the analyzer tab, I'm now going to put 217,500. Come on, computer. The loan interest rate is 6.5%. The length of the loan is 30 years. My loan start date, it's generally going to be 1 month after the start, because whenever you have a loan, you don't, unlike rent, you don't start when you first close the loan. The first payment, you put in your first payment. The first payment will be 1 month after. All right. So you can see here it's showing no payments for before it did. Moving down into the long term. So this is now showing you what your principal and interest is going to be at $1,375. Taxes and escrow. So we'll put that in over here in just a minute. And then that will give you your full pity payment. So coming over here, I'm putting in what the rent is in this particular property. It's $2,400. My insurance is $1,800 a year. This is annual over on this side. My property insurance, my taxes is $3,500. Fully expect that to go up after I renovate it. I've got your property management is at 9%. And that's fairly standard when you're hiring a property manager. But maybe you can negotiate that down. Or if you're doing it yourself, you leave it at 0. The maintenance expense, this is, and you see all of these folks, this again, where I said it's that you've got all of this information. So if you don't know what maintenance expense is, we got it explained. And then we also got the rule of thumb in there, kind of what the typical standard is. So if the maintenance is your costs, like if today I got a call from my renter saying basically his toilet had stopped up. So I had to have a service call out there to run an auger through it. When they turn over, you got to paint. You got to fix things, little dings and so forth. So there's always maintenance costs involved in owning a rental. So that's what your maintenance expenditures are. Capital expenditures are the bigger things like replacing an HVAC, replacing the roof. Your vacancies is, between renters, you're going to have a vacancy time. So that's going to be the vacancy rate. So I have those information that I'm estimating. If this is a brand new flip, then chances are, and you've just got through putting a new roof and a new HVAC, then you might be able to have a lower percentage. But if you know that your HVAC is 15 years old, then you better have a higher percentage rate, so that way you're setting that money aside in your estimates for allowances for that replacement. Appreciation. So obviously rent's going to go up, hopefully, always go up. Sometimes I have actually had it go down in one market that I had not in this area. So look at what you're looking, how much you think it's going to appreciate. Same thing for housing. Obviously, the biggest thing with renting is that you keep the house and it appreciates over time. You enter that appreciation rate, and then we all know about inflation. The cost of materials are going to go up. So you want to increase, you want to put in what you think that is going to be. And this is what's used for those future projections that I showed down below. So moving back over, so that's all the rental data we put in. Now moving back over to, I said this was going to be a cash out refi. So I'm going to change this to yes. And in this particular case, that cost to refi, because there's going to be another closing, there's going to be some additional costs. In my case was $1,406. That was my cost to refi. I mean, if you're buying points, if you have, depending on what your lender's charging, that may be adjusted, but your lender should be able to tell you that. So then basically my cash out amount is $216. So you saw up here in this deal, it was not, to do the flip, you're 92 in. Here, if you turn around to rent it and you do the BRRRR method with your refinance, you're 26,848 going into it. Running the numbers here to see the analysis, the rent, basically your gross cash flow is 584. Setting aside the allowance for maintenance, that gives you your net cash flow of 176. Not optimal, but right now we know a lot of times that's what you're having to go in at because the prices right now are so high. But that's why it's yellow. If this goes more than, I think it's 300, then this will turn green. And that tells you what your annual cash flow of 2,107. Moving down to the indicators. This is now going to tell you what your debt coverage service ratio is. So if you're getting a lender who is going to be, who will be looking to evaluate not against your debt to income, your income level, but instead based upon the revenue, it's going to be asset driven based upon the revenue of that particular asset in a rental. They'll be looking at that DSCR, and usually they're looking about 1.2 or better is typically what the lenders want, but you can find out from your particular lender. So this runs the numbers so you know what that number is. This is your cash on cash return on this particular deal with 26,848 in. That puts you at 7.8% cash on cash return. Not optimal, but this is a long play. So you're looking more longer term. The income ratio, these last two are some more, just like the 70% rule, are some more common indicator rules, but sometimes they work out and sometimes they don't. This operating expense, this will be contingent on you having a good number here. So if you're not sure that, if you think that, hey, you don't necessarily, if you put enough aside, then this isn't necessarily going to give you a good number. Now, what this continues down and provides you, so you had 26,848. This is sort of your report card. How many years to pay off the investment? So with you cash flowing, how many years is it going to take you to get your 26,000 back? That's more of a return of your investment versus the return on it is 5 years and 5.67 years. So basically a little over 5 years. If you want to compare, hey, comparing the profit from this, the cash flow from this versus say getting the money today, how long would it take you to make more money cash flowing rent versus what you'd have made if you flipped it? That's what this indicator shows here. So that kind of gives you that information. Moving down. So this is your future projection. So as we all know, when you're looking at rentals, you're looking at longer term play. So you're looking at what are those future projections? And that's what this provides you. Remember over here on the side, you get a little plus sign that allows you to expand it so you can get into individual payments. But this down here shows you by 1 year, 5, 10, 15, and 20. So in this particular case, at the 10-year point, your net cash flow will be 77,658. Well, let's say even in 5 years. So basically in 5 years, you'll make 22,000. See, so that's where you remember that return on cash. You can see where it comes out here. But if you turn around and sold that property in 5 years, you'll be making 85,172. Now we've taken into account what that appreciation is of the property based upon what you put in for that projection, and we've taken out the cost to sell it. So that's 370% return on investment. But you can see here that's obviously how much you make, but over here I expanded out to give you a little more detail. So if you wanted to see, well, how much is the rent growing each year? That's what this column tells you, the individual monthly rent growth year over year. This is how much your net cash flow is year over year. If, like I said before, if you've got a house that it's got an old HVAC and you know that in 5 years, or let's say even in 3 years, 3 to 5 years, you have to replace your HVAC. Well, this is how much you set aside. In 5 years, you will have set aside $11,000. So right now, HVACs are costing $6,000 or $7,000. So that doesn't leave a lot left if you have other maintenance requirements in the 5 years to make sure you have enough set aside to do it. The next column is tracking your investor's principal balance as it declines as you're paying it off, because of course your renters are helping you pay it off. And this is how your equity is growing. So between the buy down of your principal and also the growth of appreciation, this is how this is growing with this equity. So it's giving you a lot of information on this particular, these tabulations, so you can see how things go. And if you're looking at a deal that, hey, you look to change it out in 5, 10, 15, you've got that data. So you can make the evaluation of, is it better to make the 26,000 today as a flip or to hold it? So that's the key. And that kind of, I went into great detail walking all of these. Now I'm just going to twist them up to give you some other options. Let's say you don't have the 92,000 and you're going to use a gap funder. So if you remember back over here, when we looked at the financing within the rehab, there was a section down here that allowed gap. So keeping everything the same, let's say we're going to use gap. In this case, I'm going to use a gap lender. And that gap, 92, in my particular case, I've got some money saved up. I'm going to pull some out of my area, so I don't need the full 92. I'm going to get a gap at 50,000. So it's basically taken that information, it threw it over to the comparison tab and calculated out. It's at 15%. If you remember over here, see, I have no points, and here's my 15% if I'm looking over here on the right at my gap lender. So it's already calculating it. Now, if I had points or if I had origination, I would have to put that in here on the gap. It pulls that information back over here. And so now you can, if you remember, this was 6,000 before. It's now 8,500 because it's now added the gap cost, because you see it's with gap. It's now recalculated it. So I put 42 in and I make 24,000. So it's brought down the profit some because I'm having to pay for the additional interest, but it's increased my return on investment, where before it was 28. Now it's 56 because I don't have as much money invested into it. One of the things that I wanted to do, we didn't make this as an app, and this is an Excel spreadsheet, and we tried to make sure that it could be most versatile. So there's not macros and stuff. They're just big, long formulas, basically. So that way, even if you got an old version, it should still work for you. But it allows you, well, what if I wanted to change the price? So let's say if I think, hey, market's getting better, I can sell it for 310. I can put that in and I can immediately see how the numbers change. So that's one of the things I wanted to be able to easily tweak the numbers. What if my interest rate's better? What if? I'm all about the what ifs. Joe can tell you that, because I always like to overanalyze things. So that's where having everything on the same page and not being an app where you have to back all the way out, make the change on the original parameters, and then have it run the report, you can't see the immediate change side by side. So this is where now that's where you can add the gap to it. If let's say that you have a gap partner. So I'm going to take it where it's not in it, it's gap, but he's going to get 50,000, but it's not, it's going to be a partnership instead at 50%. Again, you'll want to put the, if there's interest, if it's a gap partner, then you won't have an interest rate. So you drop that down to 0. And if it's a 50% partnership, now basically here's the equity share. See, look, the lender's gone back down. That's their equity share. So now this is your share. And then this is how much you've put into it, and that's your return on investment. So we tried to look at a lot of different options in here. I'm going to back this out real quick because my other scenarios are without gap. Okay, so that kind of shows you the option with gap. My next example. Okay, let's say that you're going to get your lender based upon your purchase price, and Joe's got a sponsor who does this a lot. You've heard her talk a lot in our meetings, where they will offer 100% of the purchase price and 100% of the rehab. So that's this one right here in the middle. So running that one in, I've got 100% at the purchase, 100% at the rehab amount. In this particular example, I have them at still 1 point. I've got 9% on the interest. So this is telling you where your costs are. You can see that going this way, your lender costs are a lot more than if you go this way. So everything, when you're dealing with managing wealth and money, it's all about, when you're investing, it's all about using your money to work for you. So if your money's sitting in a savings account and getting 0.0001 interest, then it may be worth putting the money into this instead. But if you're making 18% on your mutual funds, it's probably better to leave it and let it continue growing, and instead pay the more money on the lender costs. So it allows you to have informed decisions. And that's my key, is to being able to have informed decisions. So if you remember here, going back, this is item number 2. So I'm going to change this to scenario number 2. As I change this, watch these numbers over here change, folks. Change this to number 2. Now, look at the loan amount paid during rehab. Funds needed during rehab. That dropped a lot, didn't it? Only $2,567. Funds needed to close, $4,200 for the whole project, 13. So I'm not going to do this one as a BRRR. With a gap funder, just running this through. But you can see how making that change reran your numbers. Now it's saying this is how much the investor's providing is $1,367. And then you can see what it automatically updates all of this information with the new return on investment. Now that's some pretty numbers, 184.76 return on investment. So that's an example running the numbers with a lender who will pay for both your purchase and your rehab. It is costing it more, but you got to put less in, and it automatically runs your numbers so you know where you're at. The next example is, let's say you've got a traditional loan. So you're looking at buy and hold, and the house isn't that bad off. So it's not that much of a disrepair. So what you're looking at is you're looking to get a lender who's going to go off of a purchase, the purchased price at, typically it's 80%, a lot of times loan to value. We're going to have the interest rate at 6.5. In this case, it's not a point, it's a flat fee. So I got a flat fee in here for this one. So this is showing that your lender rate is $5,292. I come back over to the analyzer, and this one, I'm going to adjust the purchase price because in this particular case, we're saying that the house is not that bad off. So I don't have to do that much in the repairs. So let's say that, so you're going to have to probably buy it for more. So I'm buying it at $275. It's still worth $290. In this case, let's say I only have to do paint and carpeting. So I'm going to put $10,000 in it for paint, putting carpet in the bedrooms, putting vinyl plank in all of the rest of the house, and it's only going to take me a month. So it's a lot less. So again, remember, this is buy and hold. So don't necessarily freak out at the fact that this is necessarily a negative number coming into here. I'm going to come down and run these numbers. So the loan amount, oops, I forgot to change. I'm on number 5. So my scenario changed. The loan amount during rehab is $1,392. Total funds needed is going to be $10,642 during the rehab time. Total funds with the down payment to buy it is $71,282. Again, this is a long play. This tells you what my total rehab costs are over here. So I'm not necessarily that concerned with the numbers over here. I forgot one more thing. I'm not selling. So as I said, I'm doing this as a buy and hold. So I'm not selling it. So I'm going to zero out that sales cost here. Actually, I take that back. I'm going to put that back in. My note's wrong. So you know that 2,900 really doesn't count, but I need to keep that in there because that plays down here in the future projections when you look to sell the house, because it's going to pull that closing costs and add inflation to it. So I said, don't necessarily be concerned at this number because we're down here. Put that back into the right number. So now this is a buy and hold scenario, running the numbers here. I'm looking at, this is going to be, said the buy was at, when was this again? April. We had 1 month. So now we're going to start our example in May. Well, June. Is it the same loan above? In this case, the answer is yes. My loan amount was $220. My interest rate, my goal, what I'm waiting for is those interest rates to come down to 6.5. That's what I'm looking at when I'm starting to move forward, because that's what I'm going to hold. That's my holdout time. The loan will start in May. Because remember, we got it back when we, the first payment would be 1 month after. So basically I got the 2 months. So there's 2 payments were made. So it takes that into account and it automatically adjusts the numbers down here for those payments and applying the rent to it. Was it a cash out refi? The answer is no, because the existing loan was the same. So I got to zero that out. It tells me what my principal and interest is. Everything else is staying here the same for the interest of time. It's telling my invested rate is 71. You can see it's the same as it is above. And now it's running it through. See, now these are the numbers that I care about because this was always gonna be a long-term play. I make 160 a month, not great, but my plan on this one in running the scenarios, you may be looking at, hey, well, what's it going to be in 5 years? And that's what a lot of investors are doing right now. And it's risky because you're speculating. Is what if they're not getting their great margins now, but they get a deal. And what they're looking at is they're looking at the long play, particularly if you're talking at the buy and hold. Because even though the debt service is still working out, when I start looking at, hey, in 5 years, if I go to sell it, I'm going to make 38,000. 10 years, 145. My cash flow is 75. So even though it may not work, obviously, as a flip today, not making a whole much initially, but you're looking at it being a passive long-term investment. And it gives you the numbers here to look at. And as I said, you can always expand these to see all the details. All right. For you landlords out there who have a property and are tired of getting the phone calls like what I got, if you guys, anybody who logged in early this morning, I got a call this afternoon from a tenant and there was black water backing up into his tub. This is not made up, folks. I literally spent half the afternoon dealing with this. Joe was dealing with a tree that had come down thanks to the storms, and I was dealing with sewage in a brand new bathtub. Not what I was looking for. So what if you're tired of being a renter and a landlord and you're now looking to, should I sell it? Should I basically cash out the increased value of my price? So let's run that scenario. So we take out our closing date because there is no purchase date because we didn't purchase it. We already own it. I'm going to delete the price. I'm going to delete my costs, because I have no purchase costs. Enter, come on, computer. So everything else is going to stay the same because this is an existing loan I've had for a while. Now, because I'm not what I'll be looking at here, I need to put in, because I want to compare. So if I go and sell this now, this is how much I would make if I sold the house now, assuming the fact that it still had, let's say I got to put 20,000 in it, running my full example. I need to increase some of the, 2,000 would be nice. And I'm going to do 3 months of a rehab. It's an existing note, so I need to change that note scenario to number 8. So I come over here. If you remember, that one's over here, but you don't have to enter anything here because always put the long-term loan information over here. This is always your long-term financing. So in this particular case, and this is actually my house, I have a property. My interest rate back in the good old days of 3.5%. Wish those were back today. Heck, well, come on now. 3.5. And this was from October of 2020. So you can see, I need to put this one back just so everything matches my example. Now, this particular house, I said, this is a real world example. This is my property. I'm renting it for, I wish my annual insurance was for. I'm renting it for $1,900. My annual insurance is $18. That is not actually, I contacted the county and got the current taxes on that. Oops, not quite that bad. All right. And I do have a property manager, so the property manager's holding it and everything else is staying the same. It's not a cash out, this is existing. So this is everything as it is today for my property. This is what I'm currently making as cash flow after I set aside my allowances. So now my other cat's coming up to visit. So you can see what the debt service is running. You can see the other projections here. For me to do the rehabs today to make it look the best, so everything being equal, that will put it at 24. So I can either end up making 93. I forgot to change the scenario up here when I had the numbers before. So I can sell the house because it's got to pay off my loan. So that's where up here is taking into account the loan payoff. So that puts you at 93, taking into account the loan payoff at this point. Or if I want to continue renting it, I then can compare the 93,000 today, or do I want to keep it and say in 5 years, or sell it off in 5 years and make 161,000. So you can see this gives now those landlords who want to try to run the numbers say, does it make sense to continue renting? What am I actually making? How can I compare apples to apples? And what would I meant as a comparison for the profit if I go ahead and sell it today? So that gives you the comparison for an existing loan. My last example, one thing that we've added, so this is everything in its entirety that I've showed you for our flip, buy and hold BRRR analyzer. The second tool that we have encompasses all the capabilities of this tool, but adds the owner finance module to it. So this is kind of where we take it now to the next level, and it adds the owner finance. I'm going to flip this in here real quick. I've already got loaded what we were looking at before, or fairly close to it, with the numbers here running at the 8, the 200 coming down here. No, I got the loan in here that we had before. We got the rent rate we had before. We got the cash out that we had before. Down here is where it adds the owner finance module. Now, what the owner finance module does for you, and this is if you're selling it to a home buyer as their new home, and you're going to wrap the note. And I know that if you're not familiar with this, we're going to have some other discussions and meetings that will talk more about owner finance. But just to kind of show you the capability of the tool today, what this allows you to put in is your down payment at 10%, which is common. Let's say that the buyer's going to put in 10% down payment. Their loan is at 9.9%. It's for 30 years. If you're going to have a premium, which is kind of hard with the market as high as it is now, you can add that. If you're going to have points, you can add that piece. What their closing costs are going to be. So if it's going to be a traditional, it's usually 1%. If you're going to do a double close, then it's going to be a little bit higher. Or if it's a single close where they're paying all of the closing costs. So I have that's discussed here in the notes, but you can put your information in here as it pertains. And then you put in what you estimate their insurance is going to be, which is usually about 1%. Over to the right, it's now going to show you what their loan amount would be, how much their principal and interest would be with their escrow, and what their total pity payment is. So when you're talking to home buyers, this runs the numbers so you have the key information to talk to them. It tells you what their down payment is going to be. and then also what they're bringing to close. So their total amount is $38,700. Of that, $3,200 is your closing costs, and then the other half is escrow. And it's important to break that out because a lot of people kind of get sticker shock if you're going to tell them $6,700 for closing. But a lot of that, they're just prepaying. They got to pay for 1 year of insurance first, and then they got to pay 2 months to go ahead and prime the pump for escrow, which is what we all do whenever we end up closing. But a lot of times your home buyers haven't bought a home before and don't know that. So you got to be educating them when you're doing owner finance. And over here to the right, this is now running your numbers for the buyer payment minus what the principal and interest you're paying on the loan off of this original note that you've wrapped. So instead of cash flowing $394 in owner finance, you're cash flowing $1,765. That's not a bad cash flow. On an annual basis, $21,000. So yes, you're giving up the appreciation, but if you're looking for something that's going to give you a higher revenue month over month, then you're probably going to want to be looking at the possibility of owner finance. If instead you're looking at something that you don't necessarily look at the month over month revenue, but you want that appreciation that you'll then sell the house to get at maybe a retirement. If it's, you're planning 15 years down the road to sell that rental for retirement, then you can look at that. Or if you're looking to do, a new build or something. If you scroll down to the bottom, so this is kind of telling you what you would keep as an owner finance, $14,548 in. So that's how much money you'll be leaving in the deal invested. So that gives you a return on investment of $145,000. Sorry, 145%. Sorry, I'm getting tongue-tied, talking too much. Down at the bottom, so here's where the key is. This gives you across the board comparison. So you can take year over year a comparison to what your return on investment would be if you rented it versus if you did owner finance. So let's say in 5 years, you were looking at selling it as a rental. Well, your profit would be $199,915. If you kept it for owner finance, well, and also let me throw in your cash flow will be $32,000. So if you're looking at cash flowing each month, your bank will take in $32,000. When you go to sell it, you get almost $200,000. If you did owner finance, your cash flow is $105,000. Your total profit, if you turn around and sold that note, this is assuming 100%, which for those who are familiar with notes, you usually are selling more at 90%, depending on how good you did on betting your buyer is how much of a premium you can get when you go to sell that note on the third market is $236,000. So you can see how that can grow over time. So depending on whether you're looking at needing cash monthly, which is what I'm looking at as I'm getting longer in the tooth and looking at that additional revenue for retirement, I'm wanting to get a bigger paycheck in my mailbox that I don't have to worry about if the sewer's backing up or a toilet breaks. So that's what I focus on right now because that's what works for my growth scenario, my portfolio. If you keep scrolling over, if you ended up putting all of the buyer's payment against the note to try to accelerate that note, that's what this last table shows you. So obviously this is an older note, so I don't have as long to pay it off. This is showing how quickly you can pay it down and how much accelerating that note because of the amortization of the savings will do for you over time. So basically, when you're looking at, let's say at 10 years, I might get $211,000 and the value is $349. If I accelerate the note, the value is $481. So that's what this last table does. We also have an additional module in here that allows you to affect that change and put 100% and accelerating the note so you can see the side-by-side comparison. So we tried to look at this from a holistic perspective, all the different exit strategies and the different ways that you can get loans, pay the bills, and different ways that you can either, like I said, accelerating a note, do owner financing, do rentals, do flips, so that you've got all the information, all the numbers to make the best decision when the market changes, when The rehab goes bad, you end up with lots of termite damage, you're having to do a lot of repairs. You can then adjust to say, okay, I can sell it now and maybe not make as much profit, or is there another way to look at it? Do I pivot and do another option? So that's me doing a lot of talking. I've run through a lot of different scenarios, but that's basically the 7 different ways to kind of show you how these analyzers work. Joe, let me go ahead and stop sharing real quick.
OMG. So basically, in a nutshell, Ann, you've given, along with our meetings, right, a mentor program in electronic form. So everyone on this call, uh, I learned each one of these steps or processes individually. And it's been about 15 years, and hence why Dallas REIG exists. So it's been a lot of work, but if you really look at it from a granular perspective, this is a training and ongoing training spreadsheet that you can use daily. I mean, I didn't have this. We didn't have these kind of meetings. So the thing is that we built this. It doesn't exist anywhere else to my knowledge because they're combined and analyzes them all in one place. And not only can you use it for yourself, but when you do get wholesale deals, you can actually populate the spreadsheet to see if it's a deal before you even take step out of your door, right? So powerful. And one of the things that is really important to us is for you to have a tool that you can use to call people out. So now you're the expert. So basically, I wrote some notes, which, man, my scribble. So really and truly, we're giving you how to look at an HML, joint venture partner, right? So you can talk to your joint venture partner or do it yourself. We've given and solved your interview. So really and truly, when you look at what this does, when you're interviewing, and that's what I'll say for a loan from one of those sources for a lender, you now are equipped with valuable information that you can provide to them, which in a nutshell provides you with experience. And you could use this even if you haven't done a deal before. Really. I mean, before this existed, I mean, we worked on this. We've done, and Ann always said, well, you've done them before. You all have done them before. Well, you know what? If you really get good at this tool, you can speak the language. So while in Rome, what? You can do what the Romans do with this tool. Okay. So if you want a tool that trains you daily, evaluates wholesale deals, you can run multiple scenarios, and it has all the rules, the majority of the rules of thumb. So where do you get that? So that's one of the things we wanted to focus on is what are the rules of thumb ongoing, right? And our plan is to keep this tool, viable ongoing. And then the lender options. I think the most valuable aspect of this tool are the options that you see with lenders. Not only from where you get the majority of your money, but also from the gap. Okay, because the majority of people that are starting want to be able to leverage gap, but they don't really know what the impact is, and that's what this tool shows you what that impact is. Right? We do have a sponsor, right? That is a hard money lender that provides 100% financing for the loan, and also, like she mentioned, for the rehab. Now you can see what that impact is. Okay. But the first step is owning this. Okay. And so if you do acquire this, and we've been racing to get this to you, everyone's been asking this. If you buy this today, obviously we're going to discount this for you by $50. So this tool, and she's going to show you, is $249. So she has the the real estate analyzer as well. But it was $2.99, then it's basically $50 off. And the real estate exit strategy analyzer is $3.49, which will be $2.99. But that's it. The first step is acquiring this. And this is why, everyone. This tool is basically, like I said, your mentor program. We're then going to be having subsequent meetings that are going to be running scenarios. So when we do these real world events that are actually in the field that I have, or you're going to other meetings, guess what? They're going to want to know where you got this. They're not going to have it. And so, I know it's kind of drinking through a fire hose right now, but in order to get really good at this, we're going to need to be able to use it and invite you to an exclusive group like a mastermind. Okay. So that's the ongoing goal of this, is to get really good at the numbers. So you'll know the exit strategies because you'll be forced to when you're going through and looking at all the numbers. You'll be able to look at what what the language is, right? What the rules of thumb are. And it forces us, one of the things that I really like is to always be analyzing the market. So again, tonight, and it's on our site in the store. Let me see if I can go
You were cut off.
to Dallas REIG. And I don't know if you guys can see that.
Yes, we did see it.
Yeah.
We do see a video.
Oh, you do? Okay.
Yeah. Go to the
So if
shop.
you go to the shop, you can see it right there. So you'll see the flip, buy, and hold and BRRR, and then the real estate exit strategy. So the code for you to use, the discount code is deal for you, and that's the number 4 and the letter U. So if you put that in the coupon code, it will discount it $50. So what you need to know is this is the start of this process. And so this is ongoing. And what I mentioned to a lot of you is the race to 10, right? So 10 means a multiple look at your portfolio, meaning you have rentals, you have owner finance, and then you're doing flips. So we've always said we want to keep 3 moving, right? One in, one on, and one out. But you need to know how to acquire them. Okay. So you make money on the buy, get paid on the sell. But what does all that mean? So Anne has really, really put a lot of work into doing this. And so again, we're offering this to you tonight, so you can go. And I know Rick is on the actual meeting, so it benefits him because I'm glad now he can go ahead and purchase this. But so I really hope you enjoyed this, because this is going to change the game for you, in my opinion. It gives you the ability to kind of be an armchair quarterback and analyze deals like the pros. And so if you're not comfortable, again, we're going to have meetings. Once you acquire it, then you'll come, and then we're going to have, different scenarios that we'll be able to run. So you'll be able to do that with us.
Also,
Are
Joe,
there,
I also let people know too, is that just although I think now I finally kind of crammed about every possibility in there. But as we down the road, because there are others, those who came to his fix and flip, there's some other tools I'm trying to create to help, like say, estimate your rehabs, and if you're doing new construction and running the budget and stuff. But as we continue moving forward, if we add more things to these, I'll be keeping track of whoever purchases it. So if a new version came out, like the people who had already purchased the real estate exit strategy analyzer, the first version that we had go out earlier back in November, then you'll get the new one that comes out. So we'll go ahead and send you the new one whenever there's any changes or if we add new modules to it or anything like that. So, or if there's any corrections, just like any other software, you'll get the updates.
So yeah, it's going to be ongoing. And Ann and I buy deals just like you all are. And, we're real estate professionals. We're out here doing this thing. And so this tool is going to be used. And the next step is to build one for new construction. So we're going to be working on that as well, a tool. But the first step is acquiring it. So then you're in the club, right? So then now uh, we can have meetings, kind of the masterminds to start using the tool. And then all of the rules, like I said, rules of thumb and all the training that goes along with using the tool, it'll become second nature for you. And that's the goal, right? So you're self-sufficient with understanding the numbers, and then you can kind of learn it on your own, right? At your own self-paced um, timing and then also when you're getting wholesale deals, run them through there, and then we actually have meetings, we can actually discuss those, right? And so we're really excited about it. So are there any questions?
Joe, now the difference between the two is you get everything with if you buy the more expensive one, you get it all, correct? Or do you need to buy both
Yes,
to get what we just went over?
correct.
The real
We get
estate
everything.
exit has everything. So that's the
Okay.
real estate
Okay.
exit has all three exit strategies. We basically took the buy and hold and flip BRRR and then just added the owner finance module with the other two, the accelerated and the owner finance. So yes, the 299 has absolutely
Okay.
everything.
So
Okay.
yeah, definitely.
Okay, thank you.
And one of the good things, Rick, I'm glad you asked that question, is as we're doing these trainings, one of the things that we're going to incorporate is using the tool when we're having a discussion, a topic about owner finance. Everyone on this call, if you notice when you go to a meeting, typically it's about the strategy, but they don't really take a deep dive into the numbers. That's going to be a separator, a game changer. And that's what we're doing. So our goal, like I mentioned to a lot of you, is to be project central so that you know what you're doing on a project. And so that's what this helps you do.
Hello. Joe?
Yes.
Okay.
Hey,
Hey,
Israel, how you
Israel
doing?
here. Hey, man, I'm doing well. Thank you. It's good to see you guys here. So just to be clear, we only need to buy one, right? Not two.
Correct. The real estate exit strategy analyzer
Yeah.
has all of the strategies that we discussed. So
Okay.
this one here, I don't know, can you see the screen?
Yeah. Yes.
So the real estate exit strategy, so we're taking it's $299 tonight.
Okay. So that's the one that has everything. If we buy that, we have everything, right?
Well, almost. I mean, I'm not coming home with you.
Almost. No,
But yes.
I get it. No, I mean, but every tool that we went over today,
Right.
the
And the plan
299.
is, and you come like, right, you're a regular attendee,
Yes,
is we're
sir.
going to use these tools. So
Yeah.
that's why everyone on this in this call, we want you to acquire this, because now we're going to use these tools for you
Yeah.
now to be able to analyze your deals. When
Okay.
we're not around, you can do it yourself. And that's the goal, right? So you're self-sufficient when you're going out into the field.
Okay, one more question. I see two analyzers. Joe, one says flip, buy and hold, and BRR analyzer. And then to the right is a real estate exit strategy analyzer.
Right.
So
The real estate exit strategy analyzer has the owner finance component.
okay. And everything that the other one also has.
Correct.
Understand. Thank you for the clarification. I appreciate it.
Oh, anytime.
Hello, Joe.
Hey,
How are you?
Yeah, this is Miss Burnell. I got
Yes,
on here
hello.
late. I got on here late, so I missed everything almost. So I just wanted to know. I see you got it recorded, so I just wanted to, touch bases with you. I think I'm gonna be able to get it, but I ain't gonna be able to get it tonight. But so how much would it go on sale tomorrow? This
So
$2.99.
it's $50 off of each one. So if you want the real estate exit strategy analyzer that also includes the owner finance analyzer, that's the $349, but tonight it's $299.
Okay, but I have to get it when I can get it. It'd be this week
Okay.
sometime, but I'll get it as soon as I can. I just have to pay the $349.
Sounds good.
Okay, I'll listen to it when you have it recorded.
Yes, we have it recorded, correct.
Oh, okay. Well, thank you so much. I'll get with you later. Okay, I need I've been needing to talk to you.
Okay, sounds good.
Okay.
Hey, how you doing? I got a quick question as well. I'm not sure if you guys can y'all see me? I'm not sure. I'm on iPad, so
Yes,
it's a
I
little
can.
weird.
Yeah, we can.
Okay, cool. All right, cool. Hey, man, I just want to say, great information. I think this is going to be a game changer. The world probably don't know about it yet, but I know it's going to be a game changer, 100%. For me, I got to talk to my team about it as far as like how we kind of want to go about this. If we're going to break it up into, each person buying it and things of that nature. But what was my question? That's crazy. I just forgot my question. Oh, my real question was, so if we don't buy it today, can we just go to Dallas Ridge and buy it at any point in time, or do we have to directly contact you guys?
No, it's in the store. It's
Okay.
actually on the shop. So you're the shop. Can you see the shop right there?
Yeah, I can see the shop. I just didn't know if that was
that's
going to be taken down
actually
after
our
today.
product. Yeah, that's the product that's in the store.
Okay. That's all I needed to know. All right, we're talking to y'all soon.
All right.
Joe, can you please repeat the code for the discount?
It's deal, DEAL, the number 4 and the letter U. Deal for you.
For you. Okay, thank you.
Hey, Joe, do you want me to pull up the flyer again?
Sure. Oh, let me stop sharing.
I think I'm gonna hijack it. There you go.
And you'll see the coupon code on the bottom left.
Does this special end at midnight or by the
Yes.
time? Okay, cool. I jumped on late, so cool.
And so just to reiterate, this is basically 15 years of training in one spreadsheet. I kid you not. And actually, I would take it a step further. It actually is better because it includes all of the real costs. One thing that Ann and I talked about is when she saw some of my estimates, she's like, whatever, man. I'm like, hey, that's what it was, but these are fully burdened costs. So these are looking at all your expenses, which you really need to. And then in addition to it, again, you'll be able to speak the language more than a seasoned vet because a lot of people roll up their numbers. They don't talk in details. And so you really get to get a good snapshot of what your expenses or your costs are. Right? So you're only as good as what the numbers would say you are. Not what you want them to be. So that's why this is important. I mean, I can tell you, and we're gonna start. I'm gonna go on the road. This is we're basically the first snapshot. Y'all get this, where it is now.
Does anybody else have any other questions? Sorry.
Yes, I have one. How much longer before you all roll out the new construction part of it?
Oh, we're what?
I know
So
y'all
my
just getting
snap,
started.
my
I'm just
my
curious if
goal, our goal is what I say end of June.
okay. You have any idea what the price difference will be at that point?
It'll be a lot. It'll be different.
That'll be a
And the
different
reason
tool. That's a different tool altogether.
It's a completely different tool.
Oh, okay.
Because this is analyzing a deal. Now, could you run a new construction number here? Yeah, because you basically you put your build costs as the rehab costs,
Right.
and then you can run it, because this is the deal analyzer. I think what you're referring to is to be able to estimate the build cost. And so that will be a separate a tool that we're in the process. We're putting the final touches on it. And Joe's probably about right. I'm hoping it's going to be earlier, but probably June will be a more conservative time
this
frame.
summer.
But definitely
there's-
over the next couple of months, so that you could then basically have a tool to estimate your construction costs with everything else. But that's specifically for the construction costs. So they said, where this is analyzing the deal, if you're going to flip it, if you're going to rent it, if you're going to do owner finance. Similarly, we're also working on a tool for the rehabbers that you can run your, do a quick snapshot. I showed that during the last, the on-site flip he did a couple weeks ago that we're working on. That's the next one I want to try to finish up, is where you can then estimate your rehab costs. And with a quick tool to get to a quick snapshot very quickly with some sort of ninja numbers on how to estimate windows and doors, and then running your full budget through it, and it will maintain it to your comparison budget to actuals, draws, and so forth. But that's a second tool, but it's completely separate to this. Analyzes the deal from a purchase to the sale of rehab, to the sale of a flip, or if you're going to do buy and hold long term. So a little bit different, I think, than what you were asking, what you're referring to.
Okay.
Yeah. And also these right here. So we're gonna obviously go to TikTok. We want some of you to join us with that. So we need you to get very well versed in this. Right? Which means you're gonna be doing real estate deals and transactions and doing projects. So if you all really want to do projects, this is for you.
And just to
You're
make sure, sorry,
Mhm.
Joe, just to make sure I
Yeah,
understood
go
what
ahead.
you said, she's going to add an additional part of it that considers all the different rehab costs, like kind of like what you did the other day, where you estimate costs as far as like specifics, like shingles for the roof, windows.
That will be a calculator to calculate just the rehab.
Okay.
So that'll be a different tool altogether. That will be an additional module to this. This module is comparing if you're going to flip it or rent it. That's the one. The other one is the deal analysis to flip, to rent, or owner finance. So the exit strategy adds the owner finance module, but it takes the holistic look of the deal. It's not specifically to determine what that rehab is, on like how many squares do you need for for your roof, for shingles, or how many square feet for your carpeting or your flooring. That's going to be the Excel wouldn't be able to handle enough of the back end behind that without it crashing. I struggled even actually with the exit strategy on this one. That is going to be a completely separate tool just to deep dive into evaluate the cost of a rehab or the cost of a build.
But to answer your question, Ken, to get good at this, you've got to be studying. And so, and everyone on this call, the reason why we're good at this is because we're either buying it, just like we dealt with today, we're paying for it, or we're analyzing it. And so this gives you the ability in an organized fashion already set up for you to analyze it. Right. And so when you're looking at those costs, like Ann always say, oh, you know how much that costs. Well, I paid for it. Yeah, I learned the hard way. Right. So I know I've committed it to memory, but now they're on like project tracker sheets. So what you're asking is from a rehab perspective, what all those costs are based on type, right? And so we kind of went through that at the flip that we were at. But like she's saying, that's a different component. But again, that's also going to take you all using the tool. Because what you want to be able to do is when you're in the field, when a wholesale deal or deal presents itself, is to be able to quickly analyze if it's, what you want to do with it. And like she said, all of our strategies might be different, right? Because you might be at a different life cycle or place in time for what your goals are utilizing real estate. And so, like I always say, like in my meetings, it's a race to 10. I believe if you get to 10, you can be okay. And it can be a variation of, you know, doing rentals, owner finance, and fix and flip. And then we're adding new construction. But you have to be able to analyze them. And if you're in the dark, I mean, meaning if you're not understanding how those things work in unison, then you're kind of on the outside and you're guessing. And that's the worst place you want to be, especially in this market. So we feel that we've solved this a lot. A lot of the unanswered questions for you is now you can actually analyze these opportunities that they present themselves for a very, very inexpensive price. So you're basically getting a mentor program if you study it using these tools. I taught for a long time, and I can say I didn't get as granular as these spreadsheets did. And I'd be willing to bet that if you go to most of the programs that are out there, they're not this granular. There's no way. And Ann, you went to Anderson, right? You did Anderson. I don't know if it was this granular. There might have been components, but
Yeah, Anderson was the business training and the back end piece for the business structure. It was a Nick Bertucci real estate training that I did out in California, and it was a big bus tour. And yeah, there were like 300 people there. Yeah. So.
Yeah. So, I feel like this is kind of what I've learned over all the years that we've done, and kind of put it all in one package. And also what this does, everybody, is it helps you develop relationships. I didn't even really talk about that element. So once you utilize this tool, don't you think that you'll get joint venture partners? Your lenders will feel way more comfortable with you because now you really understand the language. You can accelerate your experience just by learning this tool. I mean, no doubt. So, yeah. So, and I wanted to be able to offer this to you. We wanted to do that as a discount so that you could use it. And then again, what we're going to do is have meetings that are you looking at different scenarios so you get comfortable with it. Because obviously, right now, I mean, it's just a lot of information and you need some time to be able to take it away, as you acquire it and go and run scenarios and then bounce it off of us, and use it. You know what I mean? And that's what we can do and use it so that you get comfortable with it. Then you're off to the races and you can use this anywhere, right? So it's not just particular this market, you can use it again with any deal, which makes it really, really, really powerful.
How soon will the recording be available?
Oh yeah. So I'm still recording. So I'm doing that now.
Okay.
I just think so here's my caveat to that. Here's my exit strategy. So I have a team. I don't do all this. I just recorded it. So hopefully they'll be able to cut it up or whatever they need to. And then we'll be able to send it out to everybody.
Joe, is it possible to post it on your website?
I think so.
Because I think that would help because then everybody has a central point.
And I think we can also put it on YouTube as well.
Yeah.
So I will explore that so that you have it, Ken. Yeah, for everybody on the call. But we're also gonna obviously we're comfortable. This doesn't exist. I mean, meaning there's forms, there are different types out there, but we feel comfortable that this does a lot of different things. But it's getting you comfortable with how it works. And that's with any strategy, right? But what we want you to do is say I want to do real estate, and then I want to learn the numbers that support what my decisions are going to be when I make, when I make the decision to acquire something. I feel that a lot of people, man, I've been talking about this a lot. I feel like a lot of people aren't real comfortable with buying real or purchasing. And I think a lot of it has to do with the numbers, right? Just not sure what they want to do long term, short term, what the implications are from a lending perspective. But this gives you the ability to run those scenarios. So yeah, it's excellent, everyone. I'm telling you. I mean, bravo, Ann. This is good. But a lot of it's from you participating too, right? The group is, and I feel comfortable, right? I think the group has kind of fostered doing this type of work, right? I mean, that's the goal, is we want to be able to help everybody, because the goal for me is to get to the beach, right? It's all about the beach.
The next cruise, man. All about cruises.
The cruises, the beach, that's it. Right? That's it. That's what this is about. But you got to know what it can do for you. So, and bang up job. I mean, this is ongoing though. Like again, our hope is to have a mastermind, right? To have a group of people utilizing this tool, and then we all become really, really good at it. And then we're acquiring projects, right? We're doing projects together. It's synergy, right? We're developing relationships with lenders. We're developing relationships with wholesalers and people that are in the industry, so that when an opportunity does present itself, we know who wants those type of opportunities. And that's what this is about, everyone. And a lot of times people are reluctant to do deals. Again, it's because of the numbers. And then you have people in your network like us that you can bounce it off of, and that's the goal. I mean, it's not hard, right? Once you have it organized. So hopefully you all really like this, and you'll purchase it. What we're going to do next is those who actually acquire it, then, Ann and I'll follow up with you, for the next steps on, probably scenarios, I would think, so that you can get comfortable. We'll give you a couple scenarios, and then we'll try to just play with the tool to make sure that, you get comfortable with it. Student teacher. That's all how you get good at it, right? So
Absolutely.
the thing is too, is, one of the things this will do for all of you too is, approach different wholesalers, right? The wholesalers are going to be asking you how to evaluate. Watch. They're not going to know. They're going to say, well, why is it a bad deal? You'll be able to explain it to them. So all right, everybody. So again, if you go to our store at dallasreig.com, I don't know if you can put that back up. And
yep,
tonight it's going to be $50 off. So again, you can utilize the tool with the exit strategy of owner finance. That's the real estate exit strategy analyzer. Or if you're just interested in doing flip, buy and hold with the PRRR strategy analyzer, you can get that one as well. You can see there's not that big of a price difference. So in my opinion, obviously you want to do the owner finance methodology. I think that's the wave of the future with the higher price points, so that you can get familiar with how owner finance works. These tools force you to learn it. And then part of our team in the mastermind, and then you'll get really good at the numbers, and that's our goal. And then it's an automatic interview. You'll be able to slam interviews when you're using this tool to take it into lenders, JV partners. So again, the coupon code is deal for you. So just go on the site, go to the store, and type that in, and it'll automatically generate your $50 discount. So there you go. Any other questions? positive feedback? Come on, y'all. Anything? I mean,
I'm just excited. I'm ready to get started.
yeah, it's good. Yeah, and you'll be shocked at what the numbers will present. I will show you. You're like, what? I didn't think that. Or it's an once you switch the exit strategies, what it can generate. So
There was one comment that was saying about bundling the price next time for both analyzers. I just want to again make very, very clear, the exit strategy is everything. So the one on the left is if you're doing flips or rentals. The one on the right is flips, rentals, and owner finance. So it just added that additional module. So the one on the right, the exit strategy analyzer, encompasses everything that's already in the flip, buy and hold BRRRR analyzer. It just takes it for the second step. So just to kind of to clarify, because I saw a comment in the comment section on that piece. So some people, maybe you don't quite have the money to put the 300 out, the 299, and you're not looking to go to owner finance, and you just want to do flip and BRRRR, then or flips and rentals, that would be the flip and the buy and hold. So I said the other one is absolutely everything right now because it has the additional module for owner finance, just to make it hopefully perfectly clear.
right. So there's no need to buy both.
Right. All right, folks. Really appreciate y'all's time. I know I just gave you a fire hose of information. And hopefully, as I said, as we have more meetings and kind of conversations, that Joe, you'll be watch his Facebook. He'll be doing some little segments that will be taking pieces of this to give you more information that will help you understand it if you're not already completely, fully versed in this process. But if you come up with other ideas that you think is missing out of it, go ahead and send it to his info email, because we always look for other ideas. But I appreciate everybody's time tonight.
Hey,
Yeah.
before we
Go ahead.
Hey, Joe, I wanted to schedule a call with you sometime this week if possible.
Okay. My email is, obviously I'll put it in here. It's joe@DallasREIG. Just go ahead and send me
Will do.
an email, and then we'll set up a time.
That'll work.
And
Thank you,
again,
brother.
I'll be using this with interviews with different people in the industry. So you'll be able to see how this works. So like Ann said, you'll be seeing us utilize this. But we want you to get really good at this, because then you'll be able to participate in these projects. So all right, everybody. Well, thank you and have a really good evening. And again, go on the store and then purchase the one that you want. I think again, the real estate exit strategy analyzer gives you everything. So if you don't know about owner finance, it will help educate you, and then you can actually participate. And again, you might not be at that point. You might just want to do the fix and flip like in BRRRR, like Ann mentioned. But if you are interested in the long-term strategy, go ahead and get that, because we will be having our meetings on owner finance. So you'll be able to use the tool to follow along with us. So, all right, everyone. Well, I'll see you later. Thank you. And any other questions, y'all have my email, so go ahead and send it to me. But again, just go on the site and purchase it. And then those who purchase tonight will follow up with you for a meeting, like a mastermind. And then we'll be able to sit down with you and kind of discuss the next steps.
All right.
Thanks.